Hey traders, this is Ron Haight. Happy Sunday. Hope you guys are having a great weekend. As always, everything in this presentation is for educational purposes only. We'll kick off here with a review of the major indexes, and then we'll dive into some big hitting earnings reports that are due out this week. We'll start off here with the Qs. They were down about 1% on Friday. Here was the previous high back in February before the coronavirus hit. We zoom in, we can see we've taken that out. We've gone up, and on 7/13, which was over a week ago when I did the video, we talked about bearish engulfing, but there was no follow through. In fact, let's just zoom in a little closer. So bearish engulfing, there was no follow through. We stayed above the red line, which is our 20-day exponential moving average. That's that really nice swing trading type line. Then we bounced. We could not take out the high on a closing basis. Isn't that interesting? So right now we have a double top forming for what it is, and we finally closed below the red line. That is the first time that has happened since back at the very beginning of April. So if you take all of April, essentially, May, June, now almost all of July, we're about 4 months worth of time, and we've never even gotten below it. Now, it's interesting that this happens ahead of some major earnings reports in tech land with Amazon, Apple, Google that are due to report. So what this tells me is a close below the red line. Yeah, there was a pickup in volume, but we also finished off the lows, so it's not that bad. This is the first, I'll call it small yellow flag. First time in 4 months that this has happened practically. So yes, it is noteworthy. Is it, oh my goodness, this is really bad? No, that's not it at all. Yes, there's a double top. Yes, there's bearish engulfing up here, but there's no significant damage done on the charts yet. So going into this week, I would say caution on the NASDAQ, especially because of those Amazon, Google, Apple earnings reports that are coming up. To me, it's really all about the 50-day. This is an institutional moving average. It's what the big players pay attention to. And when we break that, that is what will be the red flag to say, you know what, bulls, for now, you no longer have this edge, and the bears are the ones that are going to have that technical feather in their cap. They'll have the edge at that point. If I go to a weekly chart, you're going to see that the bulls are still firmly in control of the weekly trend. There's no real damage at all done, which is not surprising considering only on the daily chart have we finally just closed below that red line. Let's take a look at the SPY. The spiders, they were down a little less, about 0.6%. They're still above their red line. So on the daily chart, this is a stronger, more bullish sentiment right now than in the Qs, because the Qs are below the red line. And then if we look at the Dow is down 0.75%. It's just barely above its red. The overall strongest chart going in is still the Qs because they're at all-time highs. The diamonds and the spiders aren't, but they're still above their red lines. It's just setting up for an interesting week, because I think if I show you the earnings reports, that's not what I want. That's what I want. The earnings reports this week, the biggest day is going to be Thursday, where we have Apple, Amazon, Google. That, I think, is going to decide if the market wants to enter into a pullback, or if it's, hey, good times are here again. That little dip on Friday, big whoop-de-doo, there's nothing really to watch. Individually, I have some other companies written here to keep an eye on. There's really nothing going on Monday. Tuesday, there's Boyd Gaming. Now, we just got Las Vegas Sands, and they're drifting lower, but Boyd is more of a domestic player than Las Vegas Sands is. So that'll be curious to see what's happening here in the U.S. with the casinos. McDonald's, major fast food company, right? So what are they seeing in their drive-thrus? Is it still very strong? And that's going to go with Wendy's. Now, if I look at McDonald's and Wendy's, I'll just show you these guys. Here's McDonald's. If we take out that spike high from June 8th, we would come right back up to here, which is 218, 217 area. What I would watch for on the downside of McDonald's is watch this last swing low. This is where we dipped below that institutional line and we got right back above it. Then we dipped lower, but it was a higher low, and then up we go. I'm going to watch that 178 area. If something, I don't want to say negative were to happen. It's more, what is the big money going to do to these reports? Are they pricing in future problems with the unemployment benefits being either reduced or eliminated? We have to see how that plays out. So from a technical level, below 170, that's bad news for McDonald's. We take out this high, then we go up here. Anything in between, then this is just chop trading range, maybe waiting to see how the economy ends up turning out. Now, Wendy's, it's already back at its previous high, so it's doing better, stronger relatively to McDonald's. They're both due out on Tuesday. If they both had great reports, they're probably going to pop. If they don't, they might finally get hit with some profit taking. I also mentioned Boyd. I'll just show you a chart of this. Watch those. I think the biggest play here is to the upside. If we take out that 20, I'd say 26, just round it up, then you start going all the way back up to the pre-coronavirus. I don't think that's going to happen, but that's a technical level to watch if you're looking on the upside. You definitely want to clear those highs. Otherwise, you go low, low, and there's a lot of choppiness down here. Now, Polaris was another one to keep an eye on. Back here in November and December, right as we headed into the holidays, we were sitting at just over 100. We then went all the way down to 30, right back up to 100, and here we sit. If they were to disappoint, holy mackerel, the next major support's all the way down in the 60s. That's huge, just a third of its price value being destroyed. Otherwise, if I bring in all the data on a weekly basis, you can see the all-time highs are back from 1415, which is 159. So if I zoom in here, here's where we sit on a weekly basis. We take out, I'm rounding this off, ballpark, 104. You would go back into 18 and say, wow, 130. That's about a 25% move. Then you take out 135, and then you start going back up to that near triple top in the 150s. So it'll be interesting to see what happens with those guys. Now, other companies to watch. Let's bring back up my little Word doc. We got Facebook on Wednesday. We'll see what happens there. They're having some advertisers, run away, but it's hard to not want to advertise with all that kind of eyeball exposure. But here's what's interesting on Facebook. We closed below the 50-day, albeit by pennies, back on June 26th. It was immediately reversed. So now we're coming in to earnings. And I had a question on how do you know, let me rephrase the question. It was more about how soon would you look to buy a protected put option on a stock that is coming into earnings? So the answer is, it depends. If the stock is in a strong uptrend, I don't want to necessarily buy that protected put too early, because if the stock continues to rise, I can gain from that stock price. Now you can argue that if you wait right before the earnings report, you're going to be paying a higher implied volatility, which is generally true. However, the overpayment on the implied volatility could easily be offset by the stock rising. So it's almost the same situation. It's not much different. So what I like to teach from an educational perspective, again, is, hey, a couple days before the report, I'll grab my put if the stock's in a strong uptrend. If the stock starts breaking moving averages like it did back on Thursday, I could already look to buy my protected put a day or two before the report because, hey, the stock is now losing moving averages. Boom. At the end of the day or open of the next day, I would add that put even ahead of the report because you know what? Now Facebook is below its 50-day. Technically, it's now bearish on the daily chart heading into earnings. So there's some profit taking coming in to some of the high flyers. So let's move to Apple. So here's Apple. It got below its 20-day. Same situation that I said on Facebook. Look at Apple. It's running, it's running, it's running. Well, the earnings report coming up is on Thursday, right? Well, I don't want to necessarily buy a long put a couple days early in the sense that it just keeps going higher. If I buy a put now, it's going to keep losing value as the stock goes up. Once we get below the 20-day, end of the day, open of the next day, I'm adding that protected put, even though it's still 3-4 days ahead of that report, because I'm getting some yellow flags. I'm getting some technical sell signals, if you will, by closing below the red line. So Facebook, Apple, yes, if I was going to protect my portfolio or protect those shares, I'd want to add those puts already Thursday end of day or Friday morning. Let's go to Amazon. Now, Amazon hasn't yet broken its red line, so this one would be different. I'd say, oh, okay, Amazon hasn't broken. Maybe I don't want to add my put until I get maybe to Thursday because the stock could keep bouncing higher. Now, you could also say, well, Apple, Facebook, they've already broken. There's no perfect answer. They're all good answers. I could still have my protected put now rather than wait. And if I go to Google, Google is still above its red line, albeit barely. So two are breaking, Facebook, Apple. Two have not, Amazon, Google, but they're getting really, really close. Overall, though, when you look at those four stocks, you can see some profit taking starting to come in. Let me go to a 6-month chart and we'll just go through those again. So here was Google's high, 1587. Now you're about $80 off those highs. That was Google. Let's do Apple. You were basically at 400. Now you're at 370. A little bit of profit taking, which to me is normal because you've had an amazing run. Take some profits. Amazon 33.44. Now it's down about 10% off those highs. And then Facebook was at 250, it's at 230. That's almost 10% off its highs. So again, a little bit of profit taking. And that's why when you see some of those big tech stocks, the Qs are dropping in tandem. Now on Friday, the two to watch are going to be Cat and Weyerhaeuser for me. There's a lot of other companies that are reporting that you would say that, hey, these are, a big deal and so forth. I would totally agree. But for me, Cat, how's heavy equipment doing? This stock has rebounded nicely off the lows, but are companies really going to go spend money on new equipment if they're not sure how the economy is going to play out? That's why this one could really be a surprise. And then Weyerhaeuser, you could say, well, home building, right? Lumber, what's that looking like? If I go to a 3-year weekly chart, now these are weekly candles, the target would be 31. That's like $5 off, almost 20% higher on a weekly chart. If I go back to a daily chart, let's do 6-month daily, you're above both moving average. So it's looking fine right now, but if this comes out to be a horrible indicator, this thing could get whacked as well. So I just want to see what they say. And then we're going to finish off. I had a question on Netflix, Tesla, and Domino's from last week. Now, these companies reported last week, right? They were the ones we were watching. Here was the report on Netflix. You can see 7/16, so 10 days ago. We gapped down, but we held the red line, We finally closed below it on Tuesday of this past week, and now we're drifting lower. So the target remains the 50-day moving average down at 459. We break that on an end-of-day basis, the bulls will lose their edge on both timelines. Right now, we're below the 20-day, which is our short-term bullish moving average. So short-term Netflix is bearish. We lose the 50, that's an even bigger deal. All right, how about Tesla? Tesla was $1794.99. Sounds like a sale price, right? Even with Friday's gap down of 6%, nearly $100, it's still above the red. Therefore, I call that my swing trading line. It's 20 days worth of data. We're still bullish here on the daily chart. We get below the red. Now the drop is all the way down to the orange, and that's what, 30-some%. Domino's, DPZ, it had its earnings report. You can see it right there on 7/16. BMO. We've drifted lower. We basically sat on the 50-day Thursday. Here we're still trying to cling to it Friday. Domino's on the daily chart here is still bullish. So apparently people still buying their pizza. Investors were not wanting to run from the stock just yet. What would I watch for? Just like I told you in the video from 10 days ago, it closed below the orange line for a sign of trouble. Now it did it back here, and then it immediately reverted. So what I would say is this: first sign of trouble, close below the orange. We then take out this swing low, which was the last swing point. That becomes a much bigger red flag at that point. So a little bit longer video. For this week, I'm going to plan on doing a video probably Wednesday night. We'll have Facebook earnings to talk about. If nothing is happening, I might just wait till Thursday purposely because of Apple, Google, Amazon coming out with their reports, and there should be fireworks, I hope. So far, this earnings season hasn't been that volatile. At some point, the economy is going to catch up to the lockdowns, and then there's going to be a price to pay. Maybe that's going to tie in with coming in the election, the bickering, the inability to get a deal done, or we can talk about the viability of the deal. Where's the money going to come from, right? But how's the market going to react to all of that? And is it going to start getting scared with the election coming? Is it going to start to get scared with unemployment running out, etc.? So what are we going to do? Every single video, it's going to be the same thing. The story does not change. Watch the 50-day on the S&P, the Dow, the Qs. We've reached that, and that shows a change in trader sentiment because the last time the S&P got above that institutional line, and remember, I don't give it that name, the institutional moving average. That's the investment community. Once we got above it, we stayed above it, we back tested it, and we've gotten touched here and moved higher. We break it, that's that change. So again, wish you guys a fantastic week ahead, and I'll see you in the next video either Wednesday or Thursday. Take good care.